Hello friends, hope you are enjoying this TP workshop series. Welcome to day 6 of this series. I hope till day 5 you have checked all your mails. You have also checked our videos which have been given in our mails, and if you have gone through also the mail content and you have understood the processes which we are required to undertake or which we undertake in transfer pricing. That is how we do the entire analysis. If you have not checked the mail or if you have not seen the videos, I would suggest to go back and check the same and go with the flow. These videos will remain forever on our channel, that is YouTube channel, as also the mail content will be there in your mailbox. So now, day 6, we are starting with practical application of transfer pricing methods. Now, before going to that, we need to know that how we understand what method to be selected, right? Or in transfer pricing, technically, as you might have understood by now, that it's a subjective thing, and that is where there are no specific positions for specific transactions as well. Let me tell you that clearly. In transfer pricing, the entire, as my experience of 9+ years says, that's entirely a subjective thing, and that is where it might happen that position taken for a similar transaction in different client in another client could be different for the same transaction taken by the another client. So it may happen in transfer pricing, and that is where we are here to understand the fundamentals. Let me also tell you that before going to the main content part, let me also tell you that we have launched our own transfer pricing course. This workshop is just a small part of that entire course. And if you are keen to learn transfer pricing aspects, practicalities, practical skill sets, how to use databases, how to deep dive into all such aspects that we are also discussing in this 9 days, obviously you can get enrolled into that course. It has been priced very reasonably, and the main part is that you have a group mentorship option from me where I can mentor you as a senior, and you can select appropriate packages. And even if you are fresh and you don't want a mentorship, we have a package for that as well. And entire course you can see at your convenience. So that is where you can understand, and if you want to deep dive into transfer pricing area of practice, you can learn that things from the course, and then you can start off your own. So now coming back to the topic, as we are discussing application, or where technically practically the methods can be made applicable. But before going to that, we need to understand that what these methods are. Technically, under the act, there are 5 methods, as you all might be knowing, right? And the sixth one is the other method. But let me just explain, not on technical terms, but on a practical part. These methods are technically the approaches which you adopt. Just think of a situation where if so think of a situation, or once when you are thorough with your functional analysis, so you understand that at what economics the transaction has happened by your taxpayer client, right, with its related party. Now, in this, why we use methods or approaches is because we want to arrive at an arm's length price. That is the price at which the same transaction would have happened between the third parties, like unrelated parties, right? So that is how we need to understand when we are determining the method. And let me also not use one method more of times. These are technically the approaches which you adopt. So now, let's suppose there's one example that a company A, which is based out of India, has rendered certain IT services to company B, which is based out of US. Now, how as a consultant you will compare the price at which that transaction has taken? All right, that is what we need to understand, and we need to also depict in the report or depict in your analysis that how you can benchmark that transaction. What are the approaches available? Technically, this approach is what we are saying are the methods through which you find the arm's length price for your covered, or for your client's transaction. So this is how we deal with methods and approaches, like methods or approaches. Let me put it that way. Starting from the first method, first one is comparable uncontrolled price method. So as the name suggests, comparable. So something should be comparable, right? The product or service which is there, in the transaction should be able to be compared, or should be capable of compare. So we should be able to compare that particular product or services with the third party under the third party scenario or under the uncontrolled scenario. So that is what that method suggests. Now, let me also put a fact over here that you cannot compare an apple with an orange, right? If someone is selling apples and someone is selling orange, both are different products. While both are in the same category of fruits, but still they are not similar, right, in nature, characteristics, etc. So that is why we need to understand that comparable uncontrolled price method can be only used when your product or services can be compared. We are going to also understand the example in the mail. So in the mail you will be receiving also more description on these methods where we do apply practically this type of methods. That is one comparable uncontrolled price method. Now the next method is resale price method. So as the name suggests, again, there is something which is being resold, that is something which is being bought and resold into the market or to the customers, right? So that is where whenever a resale happens, resale transactions, where there is no value addition, let me just put it that way also. At that point of time, we generally use resale price method. So for an example, if someone is sourcing some goods and just sending them goods to the other party, so that is where you can evaluate resale price method, the applicability of that. Obviously, the same will be subject to the functional analysis which you did earlier on the transaction. So that is where you can use resale price method. Then after, there is a cost plus method. Now, what is a cost plus method? That whatever cost have been incurred to sell that product or sell that services into market, that cost plus certain amount of markup, that is a gross markup, like it's a gross margin. So that is where you use, in such cases, you use a cost plus method. Now let me also tell you that when we understand or when we do the comparability analysis, we need to understand, as I said, the word approach, right? So you need to understand that either I can compare the product price or service price if the same is available and the same is available and some same is in a comparable condition. There exist a comparability conditions into that. Then I can go ahead with cup method. Else I need to understand that whether there has been any earning from the gross margins or net margins perspective or not. And that is where resale price method and cost plus method both works on gross margin basis only. They don't go towards net margin. So that brings us to our fourth method, which is transactional net margin method, which is TNMM, right? So now what is TNMM? In TNMM, technically, you evaluate the net margin earned from that transaction and you compare that with the third party comparables net margin. This is the most easiest method as you come across in transfer pricing. But this method is applicable when you cannot apply the cup method, RPM method or CPM method. And also one of the more method, which is the fifth method, which is we call profit split method. So whenever there is a transaction where more than two or more parties are involved and they're rendering some sort of services, or there is some cost contribution towards rendering of that services, and both the parties are playing major role, then you go ahead and you use profit split method. So these are the five main methods under the Indian Income Tax Act which have been prescribed under the Act and through which you can benchmark the transaction. Now, what suppose if you are not able to benchmark the transaction from all these five methods? So don't worry, there is a sixth option which is also available, which we say that any other method under Rule 10AB. So that is the method which you can use in case if you are not able to benchmark the transaction to the with the above five methods. I hope that clarifies. Now you can check your mails first and you can understand where do we practically apply this particular methods in certain practical scenarios. These scenarios could be multiple, could be there could be ample amount of scenarios, but I've just tried to make it a very simple thing, giving a simple example so that you can understand where these methods can be applied. I hope you're liking this entire TP workshop, and if you're interested in buying our entire transfer pricing course, you can check out the link in the description box. Thank you. This is C. Abhishek Bhavsar. Please check your mails now.